Here's another accounting basic: the accounting cycle. The accounting cycle is pretty much just a diagram that shows us how everything flows from beginning to the end in accounting. And we have to keep in mind that this cycle is something that happens pretty much every month. It happens every month, it happens every year. It's something that allows us to be able to keep proper records. What we start off with, number one, is we analyze the transactions based on the documents used. And so, what I understand from this is that we have things that happen normally within a business, usually go along with some key documents. And so, these key documents that are in accounting are invoices, receipts, checks, contracts, whatever it takes to exchange one thing for another. So, for example, an invoice is something that we use to exchange when we recording a sale or when we're selling something to someone. Normally, there's an exchange of whatever we're selling for an actual invoice. The invoice is the source document or the main document involved with recording a sale. When it comes to receiving money, we normally get receipts or we normally give receipts for money that we receive. So receipts are involved in the exchange of funds. Checks, we should all know what a check is. A check is just us exchanging funds without actually using money, but using a checking system. And then we have contracts. Contracts can also be used to exchange different things between two different people. So we could have a contract for a service. We could have a contract for borrowing of funds. We could have a contract for purchasing inventory and credit. So there are a number of documents, there are key documents that are always involved in a transaction in the accounting cycle. And these are the documents that we use to get the information from, to record data in the accounting system. Once we have our transaction and we've analyzed it and everything, next we put in journal entry form. So like I said from the beginning of this class, journal entries are important. From analyzing a transaction, we always record a journal entry, for keeping in mind the double entry system and the proper setup of a journal entry. We call that in good form once it's set up correctly. And from recording that journal entry, what we do is we post it in what we call the ledger. Now, what's a ledger? A ledger is a fancy word for just a document where we put all of our transactions together. Ledgers are usually broken down by account, so each account will have their own ledger. And every time we use a journal entry to debit or credit an account, it goes into that ledger. And so a ledger is just keeping a running tab on how many times we used each account and what do we do to each account. So if we use our cash account and we debited it twice and credited it 3 times, then the ledger is keeping a record of all of the debits and all of the credits, their values, their dates, things like that within the document. It's some type of orderly fashion. So we're going to get into ledgers later. I'll give you an example of what a ledger looks like at a later lesson. Those ledgers are what we use to prepare what we call a trial balance. And the trial balance is pretty much a table of contents of all of the accounts of the company and the balances at a particular date and time. And so the ledger, at the end of the ledger, we have to balance it off to get us to a particular balance at the date that we're looking for. And based on what's in the ledger for that particular date, then we take that information and we can put it in our trial balance, which that's another document that I'll put in to get an example of that as well. The fourth step in the cycle is we have to adjust the accounts and prepare an adjusted trial balance. So we've done all the work and now we have to adjust accounts. When they say adjust accounts, Normally in accounting, at the end of a month or at the end of the year, we have to make some adjustments to what we say is the balance of the account in the ledger. Why? Because all transactions that may have been started may not have been completed. For example, a key adjustment that's made every month is adjustment for salaries. Just because an employee worked for the entire month, or just because an employee may have worked up until the end of the month, that doesn't mean that we paid them up until the end of the month. Sometimes, depending on pay dates, we have some month, if they're being paid weekly, the pay date ends up at the beginning of the next month, but they perform some work at the end of the current month. And so, as accountants, normally what we do is we have to make some estimation of how much work was done for the entire month, and we have to make sure that we record the entire month's salary regardless of when we paid it out. And so normally adjustments happen because of timing differences. There are other instances that we'll get into in the next chapter of the book that show us that we have to make adjustments to the items that we already recorded in order to make sure that our trial balance and in the end our financial statements include all of the costs for that particular period. And so we have to adjust it, and what we do is we adjust it and then we prepare a new trial balance based on any adjustments made on the previous trial balance. After that point, step 5 is where we would prepare all of our financial statements. Financial statements are prepared based on a trial balance. In this instance, we're going to always use the adjusted trial balance to prepare financial statements. So if you see them say a trial balance and we have these adjustments that happen, then that means that you have to adjust that trial balance. And you're using that trial balance to put the financial statements together. Once we put the financial statements together, the last step is to close off our accounts. And closing off our accounts is a means of cleaning it up and separating one period from another period. Normally, we don't close accounts at the end of each month, but we close the account at the end of the year. And what accounts are actually being closed are normally our revenue and our expense accounts, because we want to be able to separate, okay, for the entire year, this is how much revenue and expenses we had. Because if we recall, revenue and expense accounts are on our income statement, which talk to a period of time. Whereas our other accounts, like our assets, our liabilities, our owner's equity accounts, go from the beginning, the first day the business started, to whenever the business ends. So there's no real cutoff for those type of accounts. But for revenue and expense accounts, there are cutoffs. And what we do is we close those accounts, we wipe them clean, and we start fresh each year. And so ultimately, that's what the cycle of accounting is, starting from actual transactions being recorded because of events happening within the business on a daily basis, all the way to having these accounts prepared, these financial statements prepared, and then cleaning out our revenue and expense accounts so that we can start fresh with new records each year.